Good morning, everyone, and welcome to the last webinar that the ETF BILD project is going to conduct in 2021. First, little background about the ETF BILD. My co-founders and I, which are Justin Mize of Buttonwood Communications, Rich Keary of Global ETF Advisors, Viv Strench of Thompson, Hine, and I all decided to form a not-for-profit kind of a think tank called ETF BILD, the ETF BILD Project. And our job was, as we saw a oligarchy forming at the top of asset managers and oligarchy forming at the top with index providers, we thought that we would form a group that we could surface issues that may not get surfaced in that environment. And today is a perfect example. So welcome. We're going to do a webinar on the rise of options overlay strategies using ETFs, providing downside risk protection in today's markets. This is one of the hottest topics. We've got a great panel here today. So we're scheduled for an hour. What we're going to do is I'm going to kick it off and turn to our three panelists for some self-introductions, etc., and then we'll start with the Q&A. I've got a whole slew of questions that I'm really interested in asking and facilitating the conversation. And then obviously, as the audience, if you have questions, please go ahead and look at the Q&A function or the chat function and ask some questions in, okay? So appreciate it. And so my background is I was at NASDAQ for 30 plus years, spent a lot of time in the industry, obviously, a lot of time with ETFs, and I'm now on some board, but I also work at the Georgetown University and Dental School of Business at the Center for Financial Markets and Policy. So that's me, John Jacobs. Now, our three panelists are Brad Ball, CEO of Overlay Shares, Chris Rolicki, Managing Director and Lead Principal Financial Officer at Foreside, and Andrew Serowick, who is a Portfolio Manager at ETC or Exchange Traded Concepts. So let's go in alphabetical order. By first name, Andrew, why don't you talk a little bit about you and ETC?
Sure. My name is Andrew Serowick. I joined Exchange Traded Concepts in 2018 when Exchange Traded Concepts launched a portfolio management function. Previous to that, I had worked at Goldman Sachs, where I was there for 18 and a half years. I worked in the on-exchange market making business, which eventually became electronic trading and quant trading. We were lead market makers in a little more than 450 ETFs, including what I think actually was probably the first, one of the first, if not the first, option overlay products, which is an S&P covered call fund. We were the lead market maker in that. Since I joined ETC, ETC is a white label issuer of ETFs. There are currently 53 ETFs counted under our assets under management, which are about $9.25 billion. Our portfolio management team executes trades for 46 of these, just under $6 billion of that AUM. We execute trades for both funds that are on our platform, as well as funds that we sub-advise. So we're both an advisor and a sub-advisor to other funds. And our stable of funds includes an option overlay fund, which is a mega cap portfolio that sells S&P index call options. And we've also recently filed for a covered call ETF.
Great, thank you. All right, Brad.
Thank you, John. Yes, Brad Ball. I'm the CEO of Overlay Shares, advised by Liquid Strategies. We've been using overlay strategies and marketing them for about 8 years now. My background is in the investment management industry since 1985. And, my particular, I think, interest in this industry was surrounding the evolving cycle that happens in the active management of mutual funds and ETFs, and in search of a better way, which is kind of the whole genesis of why we created Overlay Shares. I've been involved in separate accounts, ETFs, mutual funds, at the private wealth side of the equation, all the way up to the highest of the institutional business. So I've sort of been around the industry for a good while, and I'm excited to talk today about overlay strategies.
Thanks, Brad. All right, Chris.
Okay, good morning, everybody. Chris Rolicki, Managing Director and Lead Fund Principal Officer at Foreside. So at Foreside, we pair comprehensive and customized advice with best-in-class technology to help firms in the investment management and broker-dealer space continue to innovate, improve, and grow. The focus of the firm now and even after we merge with ACA Global next year is comprehensive governance, risk, and compliance solutions for the investment management industry. We are focused on boutique-style client service, innovation, and tech-enabled solutions in our support function to enable clients to focus on their core competencies, product innovation, and growth. In Foreside's Fund Officer Business Unit, we are treasurers, chief compliance officers, and regulatory administrators that live and breathe the 40 Act. We take full control of fund compliance matters, financial and tax reporting requirements, and the related filings. And in the treasurers team where I lead, we're laser focused on the oversight of the fund accounting control environment and the controls around financial reporting. We are 10 treasurers on staff, over 3 dozen clients, and I lead Foresight Treasurer Services team and been at Foresight for about 10 years.
Great, thanks. All right, so as Andrew mentioned in his opening comments, these products in one version or another have been around for quite a few years, actually, longer than people think. It's not a new phenomenon, I think, but it gets better, more refined, and I think we're seeing a lot of momentum in the space. So let's kick it off. Andrew and Brad, just give us a general background. Tell us what actually is, how would you define it for the audience? What is a ETF option combined strategy? And how do they work? Well, so let's go with Brad. Kick it off, Brad, and then we'll go to Andrew.
Sure, John. Yeah, so really, overlay can sound like an intimidating word and might sound complicated, but it's really not. All you're really trying to do is take, one asset that's invested and use it as collateral to enable you to add another strategy on top of it. It's sort of a stacking of things. And by doing it, you can make a portfolio more capital efficient. And so I think most people think in a very linear fashion. If I have $100 invested, I have $100 deployed into assets. We believe that you can use overlays in a variety of fashions, sometimes to generate more income to a portfolio, sometimes to protect a portfolio from market movement, strongly up or down, and sometimes just more of a long-term capital appreciation. But it really is a approach that really, I think, attacks the age-old thing that every investor's heard, which is, does active management work? And I think we all know the long-term statistics that a relatively small percentage of active managers outperforms passive over time. So if that's the case, it leads to many investors to only investing in passive. And I think while that can be a tempting enterprise, seems a bit defeatist just to simply accept taking a passive return, because you get all of the up and of course all of the down. And so using an overlay approach will allow you to then produce some kind of attractive benefit, whether it's controlling downside or enjoying more upside in a more risk managed approach than just through ordinary active management.
Great, thank you. How about you, Andrew? What's your take?
Yeah, I would take a pretty broad view of what exactly is an option overlay fund. What really comes to mind is having a core portfolio of securities and then overlaying some option strategy on top of that. The first thing that kind of comes to mind is a covered call, right? But it could include things like buying put spreads. I think that a lot of the innovation that you've seen over the last few years has involved more complex strategies. You're starting to see more tail risk hedging funds. Even some of the buffered products that are becoming quite popular right now, essentially you have a payoff where you have a capped upside and you have some buffering on the downside. I think all of these qualify as, I would put them in the bucket of option overlay strategies. You have some kind of a core market portfolio and you are using options to kind of adjust the return profile of that portfolio.
Are people using them, or investors, the end user, are they looking primarily for upside, that little bit of extra kick, or downside protection? Or just give us the split. Is it 50-50, 70-30? Which way what do you think? Just from your observations, and Brad, please weigh in, and Chris as well.
Yeah, I think that you're seeing a lot of both. I think that the buffered products have really captured a lot of attention over the last few years, and there's some things going on in the options marketplace and kind of the rise of flex options that maybe we'll talk about a little bit later that have kind of contributed to that and helped in facilitating the growth of those funds as well.
Yeah, I would concur. I think the sort of options 1.0 would have been sort of covered call strategies, create additional income, And just as Andrew said, I think the variety of different approaches has led people to different things. Today, if I had investors in front of, we surveyed thousands of investors, I think the two recurring themes we would mostly see is the income problem that most investors have, which is the lack of income in their portfolio, whether it's through dividends of their equities or through their bonds or income instruments. So I think that group of investors is focused more on income. The other point we would hear is protection of downsides. We're back at all-time highs or near all-time highs, and been off of quite a run. And so I do think there's a lot of investors that are spooked by that and are very intrigued by some of these defined outcome type products that give you more of a controlled experience. So I would concur. Those are the two, I think, most common needs I find people wanting to solve for.
And at Foresight, we're seeing a number of fund launches around buffer ETFs for sure these days.
Excellent. So Chris, as a treasurer of funds with options overlay strategies, what kind of structures have you seen and how are they being administered?
Sure. First consideration, I think, is you make a determination of what type of option you'd want to employ. Is it an index option, or are you buying or writing, which is the same as selling options on individual securities in order to get your hedging. Second, you'd sort of determine whether or not the fund would have a passive or an active or even a sampling type of strategy. What I mean by passive is that it's possible to set up an option overlay strategy that does not deviate from its investment mandate and effectively is on autopilot, and that at a prescribed time in the cycle, the overlay is repeated immediately after the prior one expires. And then an active one would be a component of more of an active ETF, whereby you're adding option strategies on all or a portion of the underlying positions as opportunities are presented. And then sampling would be an example of an active strategy that's employed if it's not possible or practical to have options that match up to the complete long portfolio that you're hedging. And then one additional consideration is that unlike single stock options that can be exercised at any time, the index options cannot be called or exercised early, and further, on expiration date, they settle in cash and not in delivering the underlying index holdings. So you sort of have a 1 day to realize your investment strategy effectively as that index option is closing and expiring. So of course, the positive and negatives would be sort of up to the people that come up with the strategies, but that's what sort of I'm seeing in the market.
Thanks. It definitely is interesting. And speaking of the market, I saw that another article came out in the journal yesterday, day before, about today or day before, about $1 trillion is the latest inflow in ETFs, and a huge chunk of it was into active. Most inflows into active. So very clearly, are overlay ETF strategies active? They fall in the active bucket, or is it just like enhanced, still enhanced passive? And all three of you guys can take a whack at this if you want to. So go ahead. Let's start with Andrew.
Sure, they actually can fall into either bucket. The fund that we manage right now actually is an actively managed fund that buys an equity portfolio and sells index call options. It's actively managed. The other fund that we filed for will also be actively managed. Traditionally, you've seen some index-based funds. The covered call or buy right funds. There are some index-based funds as well. But active is certainly becoming more popular within the space. It does present some challenges for the trading community in terms of understanding what is going on with the options portfolio, when rolls are going to occur, when trading might occur. So there are definitely some challenges for the market makers and the traders in this community, but active is definitely showing some growth.
Yeah, maybe if I would follow next is that I would agree that it can be passive or active. I think I think one of the biggest misnomers is that in the past there were a lot of active option trading strategies where people were actively trading options to try and make money on options more speculatively, using the leverage that inherently exists in options. And I think, most of the overlay strategies that we've seen really are not at all that. They're not really actively trading strategies. They're trying to attack a phenomenon, whether it's a risk premium that you can get to add to a portfolio, or whether it's protecting a portfolio through purchasing of protection. And so it is an active process. And I think that the key point is that how you trade those options is what makes it active. So instead of most active equity or fixed income strategies, the alpha is generated traditionally through the selection of the underlying securities and that when you buy and sell and trade them, and the concentrated position, where most of the overlay strategies, if you will, the alpha or the objective that is accomplished is achieved through the actual options themselves, not through the underlying. And so I would put them generally in the more active as opposed to passive, but they can be handled either way.
Chris, your firm sees them both ways?
Absolutely, yeah, for sure.
Okay, so let's talk. So we keep 13 options. So let's pick a simple S&P 500. So if you want the S&P 500 ETF, you can get the SPDR. And then there's options on the S&P 500 index, and there's options on the SPDR, right? Physical options and cash options. And those products have cost to them. So how, and of course, there's expirations and so on. There's a roll. So of some of these terms you mentioned. So how are those costs and how are those transactions handled? And is that a cost that's passed on to the investor, the end user? Does the firm absorb it? Is it just a reduction of the downside protection or the upside return? So, I think some folks have looked at these and said these are complicated. They involve options. They got to be more expensive. There's some risk with the roll, et cetera. So let's, if you guys can weigh in on that, I think it would really help our audience. Brad, why don't you kick it off? Yeah.
Okay. Yeah. So yeah, you're right. The first instinct is that this could be additive. So first of all, separate. There's really, generally speaking, two kinds of expenses inside of these ETFs. One is if there's any acquired fund fees, and those must be stated according to FIN rules. So, for example, our firm has some strategies where we are long underlying equity or fixed income ETFs, and you must state those because embedded inside of your ETF is the actual expense of those. So if you're trading, just pulling an example, a Vanguard S&P 500 index and it trades at 3 basis points, you have to show 3 basis points of acquired fund fees, just by way of example. But in addition to that, you have the trading expense. And of course, if you are, whether you're selling or purchasing options, there are expenses to it. Now, again, this, unfortunately, there's no blanket to throw over all of it, because in some strategies, the trading expenses can be somewhat meaningful, and others it can be very negligible. In our particular example, we use the SPX index options, and one notional contract of that right now with the S&P at 4,700 would be about $470,000. So if you're paying a very nominal, 50 basis points, 75 basis points for an option contract on a notional of that size, it is incredibly efficient, and your trading costs are so many decimal points down the zero that it's almost not worth mentioning. So it's very negligible. But the more frequent you trade those, it can start to add up. So you first want to understand what are the actual instruments that are being used to trade, what are the spreads on those instruments. That's the other benefit of using, as you mentioned, the S&P 500. They tend to trade much tighter spreads, so you tend to not have as much risk on that side of the equation. So those expenses can be, if someone's not trading the more efficient instruments and they're not, and they're trading them really frequently, can add up to a lot. If they're trading them less frequently and trading some of the more efficient index options, it can be very, very negligible.
Andrew, your thoughts on that?
Yeah, I would agree with that. The actual impact of trading commissions in this environment, trading commissions for most institutional funds are relatively low. I think that you really want to pay close attention as an investor to how frequently are the options being rolled. Even the S&P options, if you're rolling something on a monthly basis, there's a spread built in every time that you roll, and you are very often paying part of that spread at least to a market maker. So you want to look at how frequently you're trading, and then once you start to deviate from these very efficient products like an S&P index option or a SPY option, the spreads become a bit wider, so it becomes more impactful. So you really want to look at that, something like roll frequency.
So we talked a lot about the end user, which is always my focus and our focus at ETF BILD. But what about, so can you are these primarily retail products? Are these primarily institutional? Are you seeing adoption across the board? Who do you see using these products?
So I guess I'll dive in. We're seeing it across the board. Initially, the expectation was predominantly a retail / mass affluent product. There's some tax efficiencies that exist with ETFs, obviously, and that market craves that. There's also perception in that marketplace that ETFs are fundamentally more price efficient for them, tend to have lower expense ratios. Even active ETFs tend to be priced more cost effective than their mutual fund active counterparts. So I think the retail audience has been, I think, the first and most obvious example, but do-it-yourselfers are using them, finding us. There's almost not a day that goes by that we don't receive an inbound, someone who's stumbled across us through some kind of search. But also, I think what we're finding is that the liquidity and the simplicity of the ability to kind of look at the change in unit values, change in pricing of ETFs versus running separate accounts, we're finding even some higher end affluent and even some lower end institutions willing to pile into these strategies, in part because they don't have to do as much of a labor intensive process to go under a separate account contract or to engage a manager. They can get in and get out more quickly. I will say that my experience has been most of these overlay strategies tend to not be as actively traded strategies. People aren't speculating on the market with them. They tend to be longer allocations. They tend to be kind of, trying to experience a certain phenomenon in the market that is not a 1 day or 1 hour experience like some ETF trading. So the assets tend to be more sticky, so people tend to put them into these strategies and leave them be for longer periods of time.
Andrew?
I would agree with that. I think that there's a retail focus, a do-it-yourself focus, but also a focus for more advisors who are finding a place for these in client portfolios as well. And it's interesting, Brad mentioned SMA. Actually, the fund that we're currently managing, the mega cap portfolio that writes S&P index options, was actually a conversion from an SMA strategy. So definitely there are advisors who are running these funds, running these types of strategies as an SMA, and they want to use an ETF because they find that is more tax efficient.
So clearly these are complicated products. So Chris, I want to ask you, switching gears for a second, there's a big difference between spiders and Qs, market cap weighted, fixed number of securities in a plain vanilla ETF versus these ETFs with options, et cetera. So what are the unique challenges that these more complicated, complex products bring from a fund officer perspective?
So I'll first start off by saying that the challenges for the fund officers related to these types of funds and investments is not terribly large in scope compared to typical mutual funds and ETFs. That is because funds have all sorts of combinations of investments and derivatives positions. However, the challenges that are present here are really related not to the investments, but to the intent and the strategy being administered. So from a fund chief compliance officer perspective, they tell me that there's nothing really to discuss here once you confirm that there are policies and procedures for the specific investments and derivatives on top of the generic fund policies and procedures. However, the combination and intent of having investments and derivatives together does have impacts to the fund accountants, the treasurers, the auditors, and it's especially true from the financial reporting and tax perspectives. So, however, before I get into the financial statements and tax items later in the discussion, I'll just say that there are also custody and collateral considerations that we touched on just briefly earlier. Some of the complexity stems from how these investments are held in custody. The long positions are custodied at the custodian bank. In many circumstances, a typical custodian bank, however, doesn't custody certain options, and so they need to be custodied at the counterparty. Options are governed by the International Swaps and Derivatives Association Agreement, commonly known as the ISDA Agreement, which ensures certain legal and credit protections are in place for the holder of an ETF derivative. So funds that engage in certain options typically hold posted collateral in special custody accounts at the custodial bank, and these are administered by tri-party agreements with the fund custodian and the counterparty. The tri-party agreement will specify that if the fund defaults on the obligation, the counterparty can foreclose on the posted collateral. And then on the topic of financial statements, as the treasurer and financial statement reviewer of the overlay strategies in an ETF portfolio, my role would be confirming that the strategy is being fulfilled with the appropriate index option overlay by confirming the index name and the portfolio's allocation to the option overlays according to the amounts and details shown in the prospectus. In addition, I would also ensure that the posted collateral is disclosed if required. And over to the registration statement, we were talking about required fund fees and expenses for the underlying funds. Should the, in this case, we're talking about an ETF of ETF with the overlay strategy. We would ensure that those fees and expenses are correctly captured by the registration statement. And then I'll pause here because it looks like on the agenda we have some tax considerations later on. So I'll pick it up later on that item.
Great, thanks. So we've talked about challenges with custody and settlement and the role, et cetera. So Brad and Andrew, do these products pose additional challenges for traders or authorized participants in the creation redemption process? How does all that work?
Yes, I'd say all strategies pose different risks and different attributes to it. When we have historically been in active equity shops, you have to worry about how thinly traded securities are, and you have to worry about a lot of other sort of really direct investment issues. These present other types of issues. I would say these strategies are no more cumbersome than any other strategies we're working on. They're different kinds of attributes and features, but they're not really more or less than others. And I think most, I guess I would be remiss to say, just like a lot of people don't really understand what the heck cryptocurrency is or even what goes into it, people are very intrigued by the concept of it. And I think the same thing would hold true here. We can't let what sounds like a lot of complicated machinery and moving parts get in the way of what is notionally a really good concept, which is the simple concept of being capital efficient, adding something to it that produces either some protection or some extra income or return to the participant. And I think what people really care about, at least my experience has been most investors and advisors care about, is that they know that the smart people behind the scenes, like Chris, are there taking care of it, but they really want to focus more on the outcome than how the machinery works.
Andrew?
Yeah, I would say that our portfolio management group executing trades for all these strategies, there definitely are more operational complexities. I'm glad Chris mentioned the issue of collateral. This frequently means that the portfolio manager may have to do additional booking, to notify the custodian, to post collateral, move collateral, make movements between accounts. There's definitely some additional work that goes on behind the scenes in terms of booking. A portfolio manager, if you're working with a sub-advisor, can be able to help you through that. In terms of the creation and redemption mechanics, so typically options had always been handled as what we would say cash in lieu, meaning that the AP and the fund are not actually transacting the options between each other. This is something that has actually been some innovation in the last couple of years, where options now can be transacted in kind. We're not doing this for any of our funds, so I won't speak too much about it. And it's still, I would say it's still in its very, very initial phases with some of the custodians in terms of kind of filling out their process and making it a more automated process. But the market is adapting to sort of handle these these operational details, these operational difficulties, because the demand for these products is showing up in their growth in the last few years.
So, Chris, investors of all shape and size don't need to worry about the Wall Street back door, the plumbing in the background of all these issues for these products, right? There's no additional risk. It's just they may be more complicated, but there's a process and a plan and a working thing. So investors don't need to worry.
Yeah, that's right. You know, it's all in hand. It's kind of old hat, and it's pretty common in the industry now, for sure.
Excellent, excellent. All right, well then let's all three of you do switch. I got some other questions, but let's switch and go to the tax implications. What are any unique tax implications of these products along the way? How the incremental income is taxed, how is a return. So just anything at all to do with tax. Just want to
there are a fair amount of items, just because what we're talking about is straddles. And straddles are really offsetting to the the long security. In this case, what we're talking about is an ETF with an option overlay. So this of course is not tax advice, and it's sort of it really depends on the facts and circumstances and the strategies that you have in place and how often you trade these things and everything else in the holding periods. Everything is sort of impactful into this, but it's it's the concept around a straddle is offsetting, and because of that, the long security and the hedge or short option or whatever the option strategy and the long are traveling together throughout the tax provisions. So what you have is an offset in this of the two. There is also something called a mixed straddle election, which in effect the long investment and maybe the written option in this case is also 100% offsetting from a valuation standpoint. So within some of the tax disclosures, you would stumble upon a tax unrealized table that would have zero unrealized gain and loss, which looks odd, but it's, again, has to do with the straddle and the offsettingness of it all. There's also, in terms of the section 246C4 of the Internal Revenue Code, says the securities holding period is reduced for periods where risk of loss is diminished. I think that you have, in this case, lower than expected, possibly dividend received deduction figures and qualified dividend income figures in the annual report and 1099s, and that's just because of the offsetting nature and sort of the holding period of the derivatives. And then broadly, and this is even outside the tax elections, options are generally Section 1256 contracts, which means that the holding periods are really irrelevant for the underlying options. It's always going to be 60% long-term capital gains rates and 40% for short-term capital gains rates. So that enters into the discussion. And then lastly, the final computed tax numbers are really could result in large excise tax distribution requirements, or even on the opposite side, tax return of capital. And that's due to the effects of all of the option overlay strategies and the complex tax rules that are underlying it. So really, tax numbers aren't really derived until 30 years after the tax year closes. So I just suggest that if you are interested in these types of strategies, regular consultations with your tax administrator, your auditors, and your tax attorneys is encouraged with these funds to ensure no surprises and your expectations are achieved.
Andrew and Brad, your customers just going to get 1099, and that's it. Normal. There's nothing, no unique. We're not looking at K1s or other issues, right? We're looking at 1099s.
Typically, so I can speak to the the ETF structure and its tax efficiency. The ETF structure is more tax efficient to begin with, and for these types of funds, there are some other particular advantages. The ability to do creations either in kind or cash. Very often, if you have a covered call fund, you may find that as the market has been running up over the last few years, each time you roll, you may generate debit spreads. You're rolling into you're buying back a contract that is more expensive than rolling to a farther out one. You may generate debit spreads. Cash creations allow you to basically cover those debit spreads without actually having to sell shares, which is something you may not be able to do in an SMA. The ability to do some of these creations and redemptions with the options actually in kind, is another way that you may be able to reduce realized gains within the portfolio. So the ETF structure is more tax efficient to begin with, and for these strategies, there are some techniques to make these sorts of option strategies more tax efficient as well.
Yeah, I would agree with that. I think the other thing that I would just say is that really, what does the end user mostly care about? I think again, it's under the assumption that people use the index option, which I think is the more common approach. You do get this 1256 treatment, and the 60-40, 60% long-term cap gains, 40% short-term capital gains is a very attractive proposition for something that may in fact only be held for an extremely short period of time. So it gets rid of those longer-term hold requirements to receive that treatment. So that is, I think, particularly attractive. And if I were now speaking to income investors, whether you're creating extra income on your equity portfolios or extra income on your fixed income portfolios, finding income that receives favorable tax treatment is even more particularly attractive today. So again, I think all those things that everyone is mentioning are important, that there's a lot of sort of noise around them. But at the end of the day, what I have found with most advisors and clients is they care about what does their income cash flow look like and what does their tax bill look like. And in both cases, these are really favorable for them.
Interesting. So we talked a lot about these are complicated products, but they seem to be pretty routine now and delivered very well to the U.S. investor and U.S. institution. So what about outside the U.S.? Are these products primarily U.S. or other markets looking at these? They've got different settlement, they've got different options regimes, they've got different tax regimes, but are we seeing a spread of this concept outside of the U.S.?
So we have actually not yet seen it in practical purpose happening outside the U.S. We have seen foreign investors choosing to or desiring to capture this phenomenon to take advantage of this approach, and you're left with doing that on a separate account basis, or if they, through their U.S. custodian, can get access to U.S. ETFs, then that's another matter. But as far as anyone really running these types of strategies, since for us we predominantly use U.S. index options, it's really a complicated thing to get them on top of any kind of other foreign investment. So it really comes down to where they're custody. We, for example, have a foreign overlay ETF, but we use U.S. ETFs that are based on like the ACWI US, and then we add our overlay to it. So you get your foreign exposure for U.S. investors, but as far as foreign investors participating, it's all about where they custody their assets.
Andrew, thoughts?
Yeah, I would agree. I like to think the U.S. kind of leads the world in terms of innovation and product innovation within ETFs, and the funds that we've seen are primarily U.S. based, and the asset growth has been in U.S. based funds.
Yeah, but so we're not seeing a lot of people in Europe doing a FTSE 100 ETF with an options overlay strategy and things like that yet, but I'm sure they're looking at it. Right. So let's go to the innovation. Well, that's not a word. One of you brought up, mentioned the word. What about adding crypto to the mix? Not that we want to complicate this any further, but what about adding cryptos to the mix?
From my point of view, I think it's just a matter of time before someone tries that.
I would concur. I think a lot of it gets into what you're trying to accomplish with the overlay. To the extent, so as an example, overlay strategies where you're trying to generate incremental income, again, without throwing a number at it, most of those strategies aren't generating, they're not tripling an investment through incremental income. They're adding a few hundred basis points to the return. And so when you look at the volatility that exists in a crypto asset and think about throwing 200 or 300 basis points or 400 basis points to it, it's almost a rounding error relative to the volatility that exists in the underlying. So I do think that if the more likely scenario in the crypto world will be ones that more designed to mitigate risk as opposed to ones that are designed to particularly enhance the income or to increase the return. That's just my viewpoint, but yeah, I would think it's just a matter of time.
So the SEC has only approved, an ETF that is on Bitcoin futures, right? So they have not approved one. But if you think about this, and it's probably not for your firms, but if you think about it, just laying out the example, Bitcoin is bought and sold by a lot of people, right? And you could add an overlay strategy to that. So people could, as you said, Brad, it's a matter of time, Andrew, it's a matter of time, people could easily start looking at offering a product, it's not an ETF, obviously, but an overlay a derivative strategy. We already have futures on Bitcoin, just use that as an example, and we have Bitcoin in the marketplace. Probably a matter of time before someone kind of puts that together and or start issuing options, etc. So anyway, that's beyond the scope of this. That's going to be definitely up to the SEC and the CFTC and the OCC to see what they all come up with, which we all hope they do come up with. So I was given a few questions as well to roll in here, etc. So one of the things I want to ask you guys is, so when you talk to different parties about this, what is it that let's pick one group. What is it that the media doesn't get about these products? What do they think it is, and what should they think? What should they know? If you could sit down with a bunch of reporters and do a 20-minute whiteboard session so they'd walk out of there really understanding this, what would you share with reporters, with the media, the financial media on these?
Well, I'll lead off. I guess the first thing is I think it exists in a lot of things in our world today. It's the fact versus fiction. So first of all, options to a lot of people, just you say that word and it strikes fear in a lot of people. So it's a derivative. It sounds scary. They use words like beta and gamma and skew and things that scare people. And so it's like, I think a lot of people feel like they're speaking another language. So I think, unfortunately, sometimes playing into that actually makes matters worse. I think that most of those are just Greek words made to describe something that can be described in plain English more easily, like time decay as opposed to theta and things of that nature. So I do think that the media narrative sometimes does in fact scare people. The other thing that I would say is that historically options were a vehicle for madmen, for people who were mad scientists trying to use leverage to go capture or corner a market or do something where they used a little bit of capital to create a much more significant buying power. And I think most overlay managers I've seen, I think are more captured by the opposite of that, which is ways to use options to mitigate risk in a portfolio, to de-risk portfolios, to accomplish very mundane tasks, but very important tasks for investors. So I think the biggest challenge is separating the hype, the headline from the facts. And I think that it takes some repetition to get people comfortable.
Andrew, your experience with the media?
Yeah, I think when I think back over the last year or two, you see a lot more talk about options in the media. Often it's been, around retail day traders piling into call options, right? In that way, I think options have maybe gotten a bad rap in the last year or so. But I really want the media to kind of demystify it, right? As Brad has said, options are a way of mitigating risk. It's a way of putting bounds around your portfolio, around establishing a return profile that's desirable to you. So they're a tool that can be used. They can be used for speculative purposes, but they have a purpose in a portfolio to structure a particular return profile as well. So I think that we need a little more demystification of options in the media.
So let me ask you guys: do these products require a higher suitability or different suitability test than just regular ETF? If you have because they involve options, or is it because it's all part of one product? So what prevails? Does my father have to go out and become approved for options to buy these things, or is it covered by the general investor?
So generally speaking, no. But I would also say, just as there are very differing strategies, think of long short equity strategies, think of highly concentrated equity strategies versus, say, index equity investing. Those are vastly different uses of equities. and have vastly different outcomes. And the same would hold true with options. So just because a strategy has options does not mean that it's particularly complex, does not mean that it's at all risky or even more risky than the underlying asset itself. So unfortunately, there's not an easy answer, but I would say if I were advocating a strategy that was more speculative in nature and one where they were in fact using options to increase risk exposure in a meaningful way, to lever up a portfolio, then yeah, I think additional explanation and education is appropriate. But I'd say for most of the products that we're familiar with or that you're seeing out there today, I'd say that it's more an understanding they're different, but I don't think they need any specific knowledge or they don't have to go to any kind of seminars to learn how to do it or anything of that nature.
I would agree with that. You know, when you open a brokerage account, if you want to trade options, obviously that requires, you know, additional disclosure and additional approval. The ETF products that we see in the marketplace are really not using options in a speculative sense. Obviously, you could, you know, if you were to use options in a way that created leverage similar to a levered ETF. Maybe this is something that would require some additional disclosure or education, but the products that we see in the marketplace right now that utilize options are not doing this. They're using options as a mitigant to risk, not to add to risk.
Okay. All right, so let's, I got a couple of broad questions to kind of wrap things up with. So Chris, I'll start with you. What do you think, what's keeping, you know, from your perspective, and this can be about these particular products or in general with the ETF business, because I like to close on kind of the big picture. What's keeping you up at night as a fund officer or treasurer of a fund? What keeps you up at night in this business?
John, I sleep fine.
Okay, good.
Good
answer, but yes.
You know, I think we have the financial and tax reporting in hand with the administrators and the oversight of the auditors. You know, we engage our service provider partners. We do plenty of due diligence around these types of strategies and the ability for them to service them. And we find nothing different in these strategies versus you know, any other strategy that we would have in any other fund. So I was hard pressed to think of really anything in this question.
Okay.
Should be good.
And now, before we move on, in general, in the world of ETFs today, with all the things going on, whether it's the discussion over crypto, ESG, you know, I said let's go broad. Anything that has you, any uncertainty you'd like to see certainty in 2022?
Well, you know, certainly crypto does get me a little concerned in certain ways, only because, you know, it's sort of an unproven product at this point in time, and how it would interact with the funds, even in derivatives, if it gets that far, which it probably will. You know, I think that you know, crypto from the very beginning was considered, you know, property, which kind of caused a wrench in the tax compliance world, which I don't think a lot of people really understood in the very beginning. But that was a few years ago at this point in time. So I look forward to be challenged in this area as it goes forward.
All right, Andrew, what keeps you up at night with overlays, and then bigger picture, what keeps you up at night with the ETF and the world of ETFs in general?
Yeah, I mean, I would agree with Chris that there's nothing really that keeps me up too much in terms of overlays. When I think about the broader market, you know, definitely some things about crypto in the back of my mind. You know, the thing that really keeps me up at night is what haven't I thought of, or what tail risk have I not really thought of? What is something that maybe looks a little bit too good to be true right now when you sort of think of, you know, I guess a few years back, what they call the fall apocalypse, you know, XIV, which had very, very steady upward returns and then had a huge drop off, right? Is there any structure, any product where you could sort of see a return profile like that? It's, you know, not that I can think of, but the thing that scares me is, you know, it's probably not anything that anyone has really thought of until it happens, right? So it's the things that really, the tail risks that we're not thinking about that really keep me up at night. What risk am I missing here? What am I not seeing?
Brad, same thing. Start micro, then move to macro.
Yeah. So So first of all, at the micro, I do think that we get a lot of questions about on-screen trading volume, how much volume happens in a lot of these ETFs. And as I mentioned earlier, a tremendous amount of these ETFs are buy and hold instruments, very long-term buy and hold for a lot of people, which inherently makes them less on-screen volume, trade less frequency. But it also means that bid-ask spread is a heck of a lot less important if you're going to hold it for a long time. If you're going to hold something for about 10 minutes, you probably are going to really worry about your entry and exit point. So I do think that if you look through to the end instrument, if you're using S&P 500 index options, or you're using your underlying is the S&P 500, or if it's broad, large stocks, then you have to kind of look through to the underlying holdings for your liquidity, and not obsess so much about the trading volume of them. So that's a coming of age of the industry, and I would urge people to think that way and to less obsess. It's really not near the issue that I think people think it is. I think the other thing that I worry about now broadly as an industry, yeah, you know what? It's bad actors, and I think it's always that way. That's why I think we were getting with Andrew there a second ago. A few years back, we had some people that came to us and said, boy, I love your strategy, but I really like some people that deliver about 3 or 4 times the return you guys doing the same thing, to which we countered, they're not doing the same thing. They're using a lot of leverage. And they said, no, we're not. We asked the portfolio manager and they're not using leverage. And we said, well, yes, they are. Well, let's just suffice it to say they were, and ended badly for a lot of investors. So I think sometimes there are people out there, bad actors, who use somewhat comical definitions of what is leverage or what is increased market exposure at different parts of the cycle. And I worry about bad actors that blow portfolios up or set themselves on fire, affecting good actors and people who are really doing good things for investors and doing the right thing. So, because options are still strategies that involve options and overlays are still relatively in their infancy as far as raising assets, I think we are susceptible to bad actors, hurting the image of all of us.
Right. All right, so I'm going to wrap it up by asking each of you to say any last thoughts. Chris, want to go first and just say anything that we didn't cover today that we should, or you could make a prediction for 2022. Any last thoughts from Chris?
Yeah, I'm not one to speculate. I'm clearly in the back office here. I guess just in terms of rulemaking and things like that, I expect it to continue, and we'll respond as fund officers and ETFs and crypto and so on. So again, I look forward to the challenges, and it keeps it interesting for me. So
excellent. Andrew, last thoughts.
Yeah, I guess I would say, generally speaking, I'm an ETF bull. I'm bullish on the prospects for the structure. It's what I've done for the last 20 plus years, and we just continue to see more and more innovation in the space, more growth in the space. New issuers coming to market. There's always something new happening, and I don't have any specific predictions. I try not to make too many specific predictions, so they don't look too bad in retrospect. But I'm continuing to be bullish on ETFs for 2022.
Good, Brad.
Echo that. Bullish for ETFs. Every day there are meetings. I think it's definitely the place people are moving to and continuing to utilize. And I do think overlays, having been doing overlays for a long time, having had formal products for 8 years that were separate accounts that moved to ETFs about 2.5 years ago, I can tell you that the interest and popularity has never been bigger. It is exploding by my estimation. And I would say 2022 will be a transitional year, in part because several of the strategies out there are gaining 3-year track records. They'll be getting Morningstar ratings, things of that nature. And I think you will find the future to be incredibly bright for overlay ETFs going forward.
Yeah, I've been in the ETF industry since I launched the Qs in 1999, and I always say we're in the third inning because I think we are in the ETF industry still in the third inning. Before I summarize, I want to make sure we all thank Elise Hopper of Thompson Hine. She put together this entire thing, everything from technology to invitations to everything in the background. So Elise, thank you for your help, and Thompson Hine, thank you for your support. So this is our last event of 2021 for ETF Build. So for audience members or any of our panelists, et cetera, anything you guys want us to cover in 2022, please let us know. We love suggestions, and we have you can find us at the ETF BILD Project website and or any of our email addresses. So thank you. So I want to thank my panelists, Brad, Andrew, and Chris. You guys did a great job, as I knew you would. Appreciate it. You kind of broke down a very complicated topic. And I think, Andrew, at one point you said the whole role here of the media should be, and for all of us, demystify the products so people aren't nervous and afraid of them. So I thank you all for that. And we will hopefully chat soon. Hopefully we'll have a safer and more in-person 2022. So thank you, everyone.
Thank you. Happy holidays.